welcome back to EDS, and in this video I'm going to show you how to grow a small portfolio by writing options contracts and collecting a premium upfront. So the first thing you want to do is navigate over to any equities underlying. We've got MicroStrategy open at the moment, MSTR. You can use whatever you like, it doesn't matter, and we just want to see the list of expiration dates. The reason why it doesn't matter what you pick is all equities have the same expiration dates. So we're just interested in the expiration dates, and the one that we want to pick needs to be between 30 and 60 days out in time. It also needs to be a monthly, not a weekly or quarterly expiration date. Now, the only one that fits that criteria right now is February 21st, with 48 days left on that contract. So we can take this information, come over to our watch list, and simply filter out any and all underlyings that have 48 days. Any and all underlyings that have an earnings event over the next 48 days. Now, the reason for this is because we are writing the contracts, we are shorting the contracts, which means we are trying to sell high and buy back lower at a later date. As volatility increases, option prices increase. So if we're in a position and there's an earnings event coming up, as we get closer to the earnings event, volatility will increase, and that will have a negative effect on our P&L. We also want to avoid anything with a low liquidity rating level, so we filter those out. Reason for that is very simple. We want to trade liquid markets only. The more liquid the market is, the tighter the bid-ask spread. And the tighter the bid-ask spread, the less you pay every time you get in and out of a position, meaning that you keep more profit in your pocket. So at this point, I like to order everything from high to low on the IV rank column. You can use any watch list that you like. This is a pre-made watch list. It doesn't matter which watch list you use, as long as there's a nice diverse selection of underlyings. And at this point, you just simply go down the list and see what would fit well in your portfolio. Keep in mind what you already have. Don't be too heavy in any one sector or industry. Use common sense. You want to make sure that IV rank is at least over 30, ideally over 50, but over 30 is also okay. We've got GDXJ here that's trading at just over $44 a share. We've got an IV rank of 33.9 and an absolute IV level of 31.5%, which I think we'll be able to find a good position up for. So let's go over to the list of expiration dates for GDXJ, and we want to simply go over to the expiration date that we already selected at the beginning of the video, which is 48 days out in time, February 21st. And now we are presented with the options chain. At this point, we can see a list of strikes here in the middle. We've got calls on the left, puts on the right. This orange horizontal bar shows us where the price of GDXJ currently is with respect to the strikes, and this vertical orange bar shows us what the expected move is of GDXJ over the next 48 days. Now, where do we sell? What contracts do we sell? Where do we sell them? Well, we're going to be shorting. We're going to be short the contracts. We're not going to be long the contracts. And what that means is we don't want price to go anywhere near our contracts. We don't want price to breach our contracts. We want price to stay away from our contracts. Now, we can use expected move to kind of craft our probabilities. We also have the 1 standard deviation and 2 standard deviation levels marked here with the dotted blue lines, and we can also use delta. So using all three of these things to decide where we're going to sell our contracts will typically land us in pretty much the same place every single time for every single underlying. Now we are going to sell one call and one put. So let's start with the calls, and this is the expected move. We want a high probability of success, so we're going to sell outside of the expected move, and we're going to want to sell somewhere around the 1 standard deviation level. And just as confirmation or as a starting point, we can use delta as well. So we want to be anywhere between a 15 and 20 delta. So as we can see here, we've got a 15 delta and a 19 delta on either side of the 1 standard deviation level. Let's start off by being slightly conservative with the 15 delta at the 51 strike. Now, it is a Saturday, the market is closed, so take the bid and ask prices with a pinch of salt. Things will tighten up on market open on Monday, but this is just for example purposes. So Now let's go over to the put side, and we've also got again a 15 and 19 delta, which is quite nice. We don't always get the same deltas on both sides, but it's nice when we do. So we've got a 15 delta here at the 39 strike, and what that's done is that's created a range for ourselves. So a range between $39 and $51. So as long as price stays within this range at expiration, we will make money. Now, what is the likelihood of price staying within this range? Well, in the bottom left corner, we have a pop of 69%, which means probability of profit. So what that means is at expiration, we have a 69% chance of making at least 1 penny on this trade. And we have a P50, which is probability of hitting 50% of max profit if we didn't want to wait till expiration. And we have a P50 of 82%. So we're looking at probabilities of success between 69 and 82%. So we've got very, very high probabilities of success here straight away before we do any management or adjustments or anything like that during the life cycle of the trade, or of the position even. And so how much money would we actually make? So if we look in the bottom middle here, we can see it says 0.89, that's 89 cents. Each equities contract controls 100 shares of the underlying, so you'd multiply this out by 100 and you'd get a max profit of $89. Now we have a buying power requirement of $443. So we would collect $89 up front, and our broker is going to hold $443 in buying power, which gives us a very, very nice and high return on capital for a naked position with high probabilities of success. Now, what if $443 was too much for your account? Now, $443 should be absolutely fine for almost all portfolios, including small portfolios. But let's just say if you didn't like this unlimited max loss potential, or if you wanted to only use even less buying power, well, what you can do is use some of this premium that you would collect and use that to buy a contract a little bit further out of the money on either side. So we've gone $2 wide on the call side. We can go $2 wide on the put side. Now, this doesn't really quite work too well because, as you can see here, the spread is super, super wide. That's simply just because the market is closed. We've got a bid of 9 cents and an ask of $1.44. So you would never actually trade this, but something like GDXJ, you wouldn't get a spread like this. 8 deltas with an 8 delta contract. So take this with a pinch of salt, but basically the thing that I'm trying to show you here, in fact, we'll go a little bit closer just to make a point here. So we'll go $1 wide instead of $2 wide. So the bid and ask is a little bit tighter there. So we're giving up some of our premium to buy the contract. So we collect less premium up front, but we reduce our buying power requirement. And our buying power requirement is determined by our max loss. And our max loss is determined by the spread between our two contracts, which is $1 minus the premium that we collect up front, which is 24 cents. Multiply that out by the contract multiplier of 100, and you get a max loss of 76. So that's where our buying power requirement comes from. And as you can see now, our buying power requirement has significantly been reduced, and we get a much higher return. Well, we get a higher return on capital now. We have slightly lower probabilities of success, but we have a higher return on capital, and that's the trade-off. Now, if you didn't want to go $1 wide, you could go $2 wide, and your buying power requirement will adjust accordingly. You can go $3 wide, $4 wide, $5 wide, $20 wide on some underlyings. It depends. However, because of the initial buying power requirement of $443 on a naked position, I personally wouldn't even bother giving up any premium to buy some further out of the money contracts to cover our shorts. I would just leave it as a naked position like this. And if you want to know how much buying power you should be allocating to your positions, we've got a free position sizing template that's actually free for everybody to use and get a hold of. The link to this free position sizing template will be in the description. Just click on this button here and it will take you over to this spreadsheet. The way it works is you enter in the size of your portfolio. Say if it's $5,000, you can then enter in whatever the current VIX level is. It's not actually 13.2 right now, but just for example purposes. And everything below will then be automatically calculated for you. You just need to use this information to form the backbone of your portfolio, and over the long run you'll be absolutely fine. There's also an explanation here of why we've arrived at these numbers, and it tells you the maximum amount of buying power to allocate to a single defined risk position, undefined risk position, and how much of your portfolio you should be allocating to short premium in general. Now, keep in mind these are the maximum figures, so you don't need to go, for example, in this instance, maximum amount of buying power to allocate to a single defined risk position is $250. That doesn't mean you need to use $250 for every position. That is just the maximum. And it'd probably be smart to not use all $250 for every single position. But this is just a guideline. This is like a checklist, safety check, just to make sure you don't blow your account up. As long as you follow this, you'll be fine. If you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know. It is a private community, so you can speak with like-minded individuals or directly with myself. And there's a 100% money back guarantee. So after 6 months, if you have studied the full course and followed our trades, if at that point you haven't been profitable or seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free, and it's £1 a month to join right now. It's super cheap because we've just launched. The price will definitely be increasing. However, once you're in, the price is locked in for you for life. So you are rewarded for getting in early, and the aim of EDS Premium is to get you to a point where you can write options contracts, you can manage risk, you can make adjustments, you can do all of this without any external help or influence. You've learned the skill. It's something that you can take with you for the rest of your life, and we aim to get you to that point within 6 to 12 months. So with that being said, I will see you guys on the inside.